Go ahead.
Okay. Welcome to Unconventional Wisdom, our CSE Investment podcast. And we're still waiting for a couple of our people to arrive. And maybe, Marcus, have you sent all the invites to...
Oh, yeah. I sent the invites to everybody out at the same time. Okay. Sometimes they don't go through for some reason. But
okay.
They're all out there.
Well, we'll start with what we've got. We've got the two best people here, Cezanne and Joni, and Dirk, 3, and myself, of course, 4th. Super best. Welcome, everybody. If you want to call in, we have a number 214-377-1108, 214-377-1108. Call in, and we won't see your video, but you can talk to us, and the folks here can answer any questions you might have. And we also have, if you want to send an email, do podcast, compoundstockearnings.com, and we'll get that. Dirk will check that every now and then, and if we get it after the podcast, and we'll answer it, and then we'll show it on the podcast next weekend. So I wanted to always come up with some, really fantastically interesting article about why you should be using compound stock earning techniques. This one has to do with Harvard. This is an article that I'll do a link to it in the Cal Report this week in an editorial section. And here's the headline. Here's how Harvard lost $1.1 billion and paid the people who lost it $242 million. Now, what's interesting here is that what they say is Harvard has the largest endowment fund of any college in the United States. The second one is University of Texas. And this is incredible what happens. I've always called Harvard the dungeon of dumb, because typically the people that go there end up working for the government, and they screw up the government, then they go back to Harvard. But this article, I'm going to read a couple of sections out of it. Harvard made many mistakes over the last decade, according to Thomas Gilbert, a financial professor at the University of Washington. But most all of them boiled down to a single miscalculation, the belief that its top money managers, who were paid $242 million from 2010 to 2014, over 4 years, were smarter than everybody else. They always think they're smarter. Had they used Cezanne and Joni's technique, had they used Keith's technique, had they used Randy's technique for 1 month, they would have made more than they ever make. And it just seems to be these big funds like CalPERS out in California that does all the retirement funds for everything in California, either made or lost 2%, I don't remember which, last year. How can you do that? I mean, you're supposed to have the best financial minds on the face of the earth, but they all get into this same old street stuff. It's like they have mutual fund minds. And in fact, they would have done better in a mutual fund. They invest in crazy things like a avocado farm in Brazil, just all kinds of really stupid stuff. Had they put it in just an index stock fund, and they don't see which one here, but the index stock funds averaged 6.4% last year. Now that's a no-brainer, and they managed to lose all that money. Absolutely. In fact, their return over the last 10 years, decade, is averaged 4.4% a year. Average annual return, 4.4% a year. These people get paid $242 million. It's incredible. Absolutely incredible. They could be so stupid. It's just the dungeon of dumb is all it is. That points out, because right now what's going on with and those guys are supposed to be the smartest. They lose that much money. CalPERS is losing money. All these retirement firemen's funds are losing money here in Dallas, Fort Worth, because they're all doing the same old stuff they've always done. It's like you have a 2000, excuse me, keep a glass of water here. You have a 2000, what is this, 18 car, and you take it to a shop to be repaired that peaked out in 1962. I mean, give me a break. What with all the techniques that are available today, with the internet and everything that's available, like all our techniques depend on, didn't exist in 1962. Didn't exist in 1992. Just incredible stuff, and they just never change. Never change. They could have done, like I say, any one of our presenters' techniques, and they would have been tremendously ahead of the game. So we have somebody. Oh, hey, there's Keith. Hey, Keith.
Hey there. How you doing, Joe?
Fine. How are you?
Good. Yeah, you're talking about old cars. It sounds like going down using the cars in Cuba, which they're all 1960 or 62 kind of vintage cars down there.
Exactly. Did you hear what I was talking about, Harvard?
Yes. Yes.
Yeah. Can you imagine those over 4 years, they were paid $242 million to handle their fund, and they lost $1.1 billion. Isn't that incredible?
Yeah, I could do that for them.
Yeah. Let me cut this sound off here. Yeah. So Keith, what's going on?
Oh, just trying to keep my head straight on this market going up and down like crazy and pick some new positions to get in. And normally I look for one of my CMICs to open. The Iron Condor's open today, but one of my rules is when the monthly jobs reports comes out, I don't open it on Thursday. I wait until the jobs report comes out tomorrow morning. So we'll wait and do that tomorrow morning. The good thing is we're getting a lot of premium on those things now. Yeah. Assuming you can open it wide enough out that you don't get the volatility of crazy stuff happening.
Tell me again, what do you think your returns are year to date this year?
Slightly down. I had that one CMIC that went bad on me a couple weeks ago. Actually, two of them went bad on me. So probably down slightly. CSM trades, I've had. I think I'm up 13.7% for the year.
Okay, fantastic.
So coming back on that, and the other thing, Joe. Yeah, we learned when the markets are really volatile like this, Iron Condors, you need to be patient and pick the right ones or not get into one. And
well, you can be patient because that's a return that obviously, what do you think these guys at Harvard would pay you? They paid the other guy $242 million to lose $1 billion.
That's right. That's right.
What would they? We ought to write. You're up there. You ought to drop by and visit those guys and tell them and bring in Cezanne and Joni and Randy and say, hey, look, in 1 week, we can make more than you made 4.4% average over the last decade per year.
Yeah.
Incredible stuff.
Yeah. It really is. That's why you really need to take a hold of your own finances too. So it just doesn't make sense.
Getting more and more important that people do that because they can't depend. Of course, you can do a mutual fund. Mutual funds don't make anything, particularly unless you got lots of money. If you got lots of money, you're going to retire, in 45 years or something, and you may have enough, I was thinking the other day, the first house that Cezanne moved into when she got out of the hospital from being born in a very nice subdivision in Little Rock, Arkansas, the house payment was $67 a month. $67. It was an architectural design house right out of Better Homes and Gardens. Windrock Enterprises built it. It cost, including the land, $25,000. It is still there today. It's still a very nice neighborhood. And you had to walk across a bridge to get to it. It had all different kinds of levels. And it was really neat. $25,000, $67 a month.
The other thing, Joe, is about just taking a hold of your finances. If you want to do just something that doesn't take a lot of time at all, in fact, hardly any time, do the dogs of the Dow and write a call against that out of the money and just let it go.
We've been talking about that for years. And every now and then we'll give an example of it. Dogs of the Dow. Even when I was at Merrill Lynch, they guaranteed a 10% return back then, back in the dark ages, on the dogs of the Dow technique that they use. Now, I don't know if they still do, but 10% return, they guaranteed it. If dogs of the Dow didn't make it, then they were going to pay you that anyhow. And if you're doing that with covered calls, and if you just have a stock, you have a General Motors, you have any stock that you like, you want to keep it forever, it pays a dividend, just do an out-of-the-money covered call each month. There's no way you can lose any money. It's impossible. And you're going to pick up some degree of additional. It's probably going to make your dividend returns 3 or 4 times, 5 times more. Not the dividend, but I mean the total return that you make.
Right.
Incredible stuff. It wasn't too long ago you couldn't do that. I mean, because this stuff didn't exist on the internet. The techniques that we're using, which nobody uses but us, didn't exist. And incredible stuff. But yep, you're right. Now, what's interesting too.
Hey, Joe, this is Erica. Yes, it's also important to note here how inexpensive it's become to do this.
Absolutely.
When I started trading, years ago, I did the dogs of the Dow, but I didn't have internet access like we do today. I would get a CD-ROM sent to me daily with all the closing prices from the previous day that I could sort down to and find the underperformers and the guys that were in the bottom 5% and use that same strategy. But I think I paid close to $1,000, if not more, just to get that data every month, like $995, just to get that data mailed to me every single day. Now all I have to do is jump online, and it's all right at my fingertips. Well, entirely different game now.
And that's like Cezanne and Joni's new technique, the micro moment, very difficult to say, technique where, you talk about day traders. This is better than day trading because day traders work on speculation. Micro moment works on the basis of our advanced charting. And their transactions are only, maybe 30 seconds, 15 seconds, something like that long. But let me tell you what's improved over that service. And you remember this, Dirk, from years ago when they started. They would have a position go against them, and they would sit there, and they would end up losing 15, 20%. And now they've got it down. So Joni had a position today; she lost 3% on. Well, that doesn't even begin to distort what they've made for the month, as far as their other income. That's nothing, And it used to be, and you and I used to, butt our heads and scream at them and everything, not to them personally, but just into around the neighborhood scream, when they wouldn't get out of a position. But that's why their services are good. They've been doing this for how many years, Joni? Cezanne, Joni?
About 7 or 8 years. And, during this sort of evolvement of Trade the Moment that we've been doing for so long, is that Cezanne and I have developed this system of drawing lines. And so in the last couple of years, we've been able to pinpoint, because we've developed this lines, that we can get in and out quickly. We can get in and out with minimal loss. So the whole process has evolved, just like compound stock earnings has. And so now we're at a place where, like you said, losing 3% as compared to gaining 12% last week, we take that loss just a little bit better than we used to be able to.
Well, yeah, because everybody, don't care what kind of investor, there's always going to be some kind of loss. It's different. You want more gains than losses. So.
Joe, I watch a lot of Discovery and animal TV at home. I absolutely love that stuff. And watching the girls trade reminds me of a lioness hunting. One of the things I've seen in their transition, what Joni was just mentioning, is used to the distance between when they would buy after their prep was much closer. Now there's a level of patience, like a lioness stalking her prey, where the prep comes out. Wait, bam, kill, done. Yeah. And it's just like watching a wild animal hunt. So good job, ladies.
That's a good example, and of course Keys, which is a totally different trading technique. He's not quite as fast, but sometimes they're really fast. And he does the same thing. Like, something's down. Hey, his returns for the year are so astronomical, just incredible. And everybody's on the podcast. If you don't know, Dirk is actually broadcasting first time on the podcast from Puerto Rico. In his new place, his home was totally devastated during the hurricane, so he has a new place. And our office, of course, is in San Juan, and he's located where we both live, about 30 minutes out of San Juan, and at Palmas del Mar. And so, Dirk, it's looking good over there. Working out okay?
Joe, the biggest difference is the lack of trees. We lost a lot of trees, down here. It used to be beautiful in terms of almost looking like a rainforest jungle. Yeah. Other than that, there's still some damage to the structures. Roofs and things like that still need repair. But overall, life has kind of returned to normal. Things have stabilized. Places are open. Restaurants are serving. People are having beer at the beach. All the stuff you would expect to see.
Did you tell Ivan I miss him?
I did. The first night I was in there, he asked me how you were doing.
Yeah. Hey, I sent you that correspondence I saw the other day about those 30-foot waves.
Yeah, that was the weirdest thing, because they were pounding the north side of the island. But here, the ocean was smooth as glass. I had never seen it this calm before. It was really weird.
Just on the north side. Okay. Yeah. Well, that's cool. I was getting ready to say I was going to talk about something. For folks listening, if you want to get our cow report, which comes out each weekend, comes out on Friday. It's dated on Saturday. It's been going on now for 19 years. In less than a year, we have our 20th anniversary. We're going to have to do something special. Our 20th, can you believe that? 20th anniversary. And
that's a lot of editorials.
And go to our compoundstockearnings.com, and you can get that cow report. It's free, and you get it. And you can also get all kinds of other information off of the website. You can see all our tools that we use in our toolbox to effectuate the management of our techniques. You'll get every every week, and that Friday, all the correspondence we have, people complaining or not complaining, or how good they're doing, how bad they're doing, asking questions as to how they can, make better or fix things or do whatever. And there's just all kinds of stuff in that Cal report. You really get to know what we're doing. And there's also schedules of our seminars. And Cezanne and Joni, you have a seminar coming up when? An all-day seminar? Joni, Cezanne.
We have it coming up on Monday, I was waiting for Cezanne. We typically talk over each other, but it's going to be April the 16th it's a Monday. And so we're in the market all day long. We trade all day long. We walk through trades. We teach how to prolong profit, certain things that we don't necessarily get to in our abbreviated webinars, but we talk about how to get out quick, like exactly what happened today, how to use the lines to ensure that you're not losing a big percentage. So that happens Monday, April the 16th.
Okay. And if you'll know, that's on a Monday, which means the market is open. And I don't know of anybody that does seminars when the market's open. I know when we do our 2-day and our other ones, I believe all of them. I'm not sure about all Randy's, but the market's generally closed. And so that's pretty fantastic seminar that they've got coming up. And you can subscribe to their service and attend that seminar. We also have a special going on for their micro moment trading. I'm never going to be able to say that easily. For right now, is it $243? What is it, Dirk? For you get a 2-week free trial, and then if you want to subscribe,
free trial, then $249.
$249, which is a super deal because they make I don't care how much money you get, you make more than that with one of their trades. So it's pretty neat. Okay, does anybody else have any great breaking news they want to talk about or anything? Nobody? Silent? Even Keith, look at him. Got his big ears on.
Yeah. Got to keep warm up here.
Keith, let me ask you, Keith. Now, again, I read this or briefly talked about this article in Harvard. You're up there, and your daughter goes to all those fancy schools up there. What is your take on that? Why would Harvard pay these guys $243 million to lose over $1 billion and only make 4% per year for the last 10 years? Why is that? What's the mindset up there? Sort of like between thinking about California and thinking about Puerto Rico. I mean, it's just such a difference night and day.
I think part of it, Joe, has to do with the crony network on hiring people out, but also more afraid of change. I don't know. You would think that out of something like Harvard that they would be trying to push the latest and greatest and really be innovative thinkers, but seem to be stuck in a rut and afraid to make a change on this. It's the only thing I can explain.
I think we all just contact somebody, just one person there, and say, look, listen in to your seminars, your techniques, follow the trades, Cezanne and Joni's, Randy, and just see, what it can't be that complicated. Why do they have to be so? I mean, I experienced that on Wall Street when I was with Merrill Lynch. I mean, and they just think they, know everything.
Hey, Joe, a lot of that comes down to the old billing model that's still around, where the investors for the endowment are probably making a flat fee, never mind performance, but they're probably making a flat fee on the assets under management. So they're probably pulling 1%, 2%, 3%, whether they win or lose. So they've got it made. So what incentive do they really have to work that hard? I mean, 3% on a couple $1 billion will rack you up a nice payday.
You're absolutely right. You
need to move away from that, and compensation for these type of things needs to be performance based, not based on how much money you're sitting on.
But Doug, look, every mutual fund is that way. They charge a fee, whether you make anything or not.
It needs to change. That's what I'm saying. That's antiquated.
Absolutely.
People aren't going to stand for that for the long term. They just won't.
Absolutely. Absolutely incredible stuff. But again, that's why everybody listening needs to take control of their own finances. This is easy stuff. You can't get better support. This podcast, which you can listen to, and all the other ones over and over and over again on YouTube. And you just can't help but learn, because these techniques are simple. There's no speculation. There's only a few rules. We got all the tools for you. And if you can't see what's happening in the investment world, when you got somebody like Harvard, you got the CalPERS out there, and every mutual fund, virtually, I'm sure, I can't speak for everyone, but not mutual fund, but every retirement situation is having big problems, because they anticipate earning 7 or 8%, and they base their retirement benefits on that, and then they haven't earned that in years and years and years. And CalPERS just put out a new, they're going to earn 7.5%, and they based all the charges they charge all the municipalities that use them based on that. They hadn't earned 7.5% in 5 years. They lost 2% or made 2% this last year. I don't know which one it was. Incredible stuff. So that means they're going to end up billing all those municipalities for the difference in money, or reduce the payments to the retirees, which is difficult to do. So, yeah, that's my rant for the day.
Joe, tell us what you really think about it, though. I mean, really.
I'll try to be. Yeah. The only reason I'm being so calm and collected is because Dirk's on here in person.
Well,
in person, I don't get to say a lot of things that I typically think. He has a special sack he throws over my head when I start, in person. So, oh well. So, okay. Well, I guess we'll call it a day. Dirk, you don't have any emails or anything?
No, not today, Joe.
Okay. Very good.
Latest on charting, Dirk, this week? Or?
Having some issues with the Friday lines and a couple of things that were still outstanding. I got an update yesterday. They're still working through those, but I don't have an ETA when they'll be fixed. I've asked to see if we could do a soft launch without some of those features, because I still think there will be some benefit to moving forward that way. I'm waiting to hear back on that.
Okay, good.
Yeah, and I think we're going to end up doing the soft launch thing like Dirk suggested, because here's the problem. They have been trying to find every problem in the world, and you can't find every problem in the world until you get it out there, and somebody like Keith or Bill or Jimmy John, whoever, writes in and says, hey, this isn't working. Then they can fix it, because every time they think of a problem, they've been able to fix it quickly. And I'd rather get it out there and have few people call and say, hey, it didn't work for me. Just like every day there's somebody that calls, because they downloaded on their smartphone, the app for getting, these trades and stuff. So you never know,
Yep.
Anyhow. Okay. Well, thank you, Dirk. Thank you, Keith. Thank you, Cesar and Joni. And we will be talking to y'all again. Thank you.
Have a good week, everybody.
Bye-bye.